I had a whole intro planned, and then I saw the failure rate numbers again.
Yeah.
And
Yeah.
just, yeah, let's talk.
Okay. What numbers? You were literally just pacing around the studio before we started recording, like staring at your laptop and muttering.
I mean, I want you to picture 300,000 people, okay?
300,000.
Yeah. Like, imagine 3 massive football stadiums packed to the absolute brim.
Yeah.
Every seat taken. And every single person is just sitting there in front of these glowing monitors, sweating, looking at candlestick charts.
Okay, I'm picturing a very stressful Super Bowl.
Exactly. And they're all convinced, like literally deeply convinced that they're about to become millionaire prop traders. They paid hundreds of dollars in fees, they put in the screen time, and they think they have the edge.
Right.
And then in less than 30 days, out of those 300,000 people, 285,000 of them are completely, utterly wiped out.
Wait.
Wiped out. Accounts terminated. Done.
Okay, hold on. 285,000 out of 300. Wait, what are you even looking at? Where is this coming from?
I'm looking at the proprietary trading firm data, the evaluation data. For this deep dive, we pulled together this massive, massive data set from across the prop firm industry.
Okay.
We're talking over 300,000 individual trading accounts. People who are paying to take these evaluation tests so they can get funded to trade institutional capital.
Yeah.
And the failure rate is, honestly, it's just a bloodbath.
A bloodbath.
It's 90 to 95%.
95%. Wait, so you're telling me out of 300,000 people who pay, like, real money to take these tests, 95% of them just lose? Like, instantly lose their money and fail?
90 to 95 fail the initial evaluation, yeah. Just right out of the gate, boom, done. Account blown.
That is...
And wait, it gets worse.
How does it get worse than 95% failing?
Because that's just the first phase.
Yeah.
If you look at who actually gets a payout, like real money deposited into their actual physical bank account, it's only 5 to 10% of people on their first attempt.
You're kidding.
No. Most people who actually get funded, who actually manage to make it through this insane gauntlet, they fail like 2 or 3 times before they finally figure it out.
Honestly, if 95% of people fail a test, isn't this just a giant scam?
It's not.
No, listen to me. Like, why is the person listening to this deep dive right now even trying this? It sounds like they just want to harvest your evaluation fees. It's a casino.
No, it's not a casino.
It's an absolute racket. You pay a fee, you fail, they keep the fee. That's a racket.
Look, I know it sounds like one. I get the reaction. But you have to look at the actual mechanics of what's happening.
The mechanics of stealing money.
No, the mechanics of the rules. Because if you're listening right now, you're probably looking at these challenges and you're thinking, well, I'm in the 5%.
Right. Everyone thinks they're the exception.
Exactly. Everyone thinks, oh, those other guys just don't know what a moving average is, or they have bad psychology, but I have a system.
Yeah.
But we need to look at exactly why those 300,000 accounts blew up.
Okay, so why?
Because the crazy part is, it's not because they don't know how to trade.
Okay, wait, stop. Stop right there.
Right.
If you fail a trading test, it is because you are bad at trading. That's literally how tests work.
No.
If you take a math test and you fail, you're bad at math. You don't fail a math test because you're good at math.
No, that's exactly what I'm trying to say, and it's driving me crazy. People don't read the rules.
They're rules.
Yes, they do not understand the environment they're stepping into. The thesis here, if you parse all this data, if you really dig into the spreadsheets, is that the failures are mostly rule violations.
Rule violations?
Yes. It's not bad market direction. It's not like, they bought gold and gold went down and they just made a bad call.
I mean, it has to be that sometimes.
I mean, sure, sometimes it is, yeah. But mostly it's people tripping over these hyper-specific, rigid parameters that the prop firms set up.
Okay, but I mean, think about what you're saying. If the rules are so rigid, so impossible to navigate that 95% of people fail, it's a scam.
It's not a...
You can call it rigid parameters all you want to make it sound fancy, but they are designing a test to fail people so they can keep the $200 or whatever the fee is.
They aren't rigged. They are risk management. Look, let's just get into the actual reasons, okay?
Let's hear the reasons.
Because there are 5 primary failure reasons in this data set. And we need to walk through them step by step so the person listening right now doesn't just become a statistic.
Okay, go.
Because the biggest killer of the thing, taking out the absolute most people by a mile, accounts for 40% of all failures across all the firms.
80%? What is it?
The daily loss limit.
A daily loss limit, which is what exactly, like you just lose too much money on a random Tuesday and they fire you.
Basically, yeah. But it's the math that messes people up. So most firms have a daily loss threshold of, let's say, 3 to 5% of the account balance.
Okay.
So if you sign up for a $100,000 account challenge and has a 5% daily limit.
Then you can't lose more than $5,000.
Exactly. You cannot lose more than $5,000 in one single trading session. If your account equity drops $5,000 from its starting point at midnight, you are locked out.
Locked out.
Challenge over. You failed. Done.
Well, yeah, obviously. I mean, 5% of 100,000 is 5,000. I don't see how 40% of people can't do basic calculator math.
Right. But it's not just the math.
Wait, honestly, think about this for a second.
Think about what?
If I can only lose $5,000, I don't have a $100,000 account.
What do you mean? Yes, you do.
No, I don't. If they lock me out the second I lose $5,000, I have a $5,000 account with like 20x leverage.
That's not how it works.
Calling it a $100,000 account is manipulative marketing. It's completely deceptive.
No, it's not. You have $100,000 of buying power. You are entering the market with $100,000 of force behind your trades.
But if I lose 5,000 and they literally shut the account down and lock me out of the portal, the other 95,000 was never mine to use.
Because it's a risk limit.
It's fake. It's fake capital. It's a ghost number just sitting on a dashboard to make you feel like some big shot on Wall Street.
It is not fake capital. You get the profit split on $100,000 of buying power, so it is a $100,000 account.
But the risk...
Listen to me. Listen.
Yeah.
If you make a 10% return on the account, you make $10,000, right?
Sure.
The firm splits that with you. Maybe 80-20, maybe 90-10 in your favor. You don't make 10% on $5,000. 10% of $5,000 would only be $500. You get the leverage of the large account. That is the entire point of proprietary trading.
Okay, but it is still functionally a $5,000 account if that is my maximum risk. My life bar, like in a video game, right? My life bar is 5,000 hit points.
I mean,
they're just slapping a 100K label on the box. So you, the listener, pay a higher evaluation fee to take the test.
Like, look, if I came up to you, a total stranger on the internet, and just handed you...
They are overcharging for the test.
Let me finish. If I handed you $100,000 in pure risk capital, that's insane. Nobody is going to do that. No firm is going to say, here's $100,000, go see if you can lose it all before Friday.
But they tell you it's $100,000.
A 5% stop loss is standard institutional risk management. Hedge funds don't let their desk traders lose 5% of the fund in a day either.
But hedge funds don't sell evaluation tests to retail traders.
That doesn't mean...
They don't run YouTube ads telling people they can trade from a beach in Bali if they just pass this one test. I can't get past the framing of it. It's dishonest.
It's not dishonest.
You, the listener, you're paying for what you think is a huge account.
Right.
But your actual tangible runway to make a mistake is $5,000.
Okay, I hear you. But you have to understand that the leverage is what matters for the upside. And the reason 40% of people hit this limit isn't because the limit is somehow unfair or mathematically deceptive.
Then why do they hit it?
It's because of emotional revenge trading.
Revenge trading.
Yes. You have to realize, like, I know you sitting at home right now are thinking, I'd never lose $5,000 in a day. I'm careful. I use stop losses.
Right. Everyone thinks they're careful.
Exactly. But imagine the psychology of it. Imagine you are taking this challenge. You've been studying for months. You paid your fee.
Okay.
You take one trade in the morning. It's a textbook setup. Everything looks perfect.
Oh.
And you get stopped out.
Ouch.
The market just twitches. And you lose $1,000.
Okay, so I'm down 1,000. I have 4,000 left of my my life bar.
Right. You're down 1,000. And you get mad. You feel like the market tricked you. You feel like you were right. But the timing was just a little off. So what do?
I don't take a walk.
No. You want to make it back instantly, so you take another trade. But this time, you double your position size because you want to erase that $1,000 loss with one really good move.
Oh, I see. So people just get tilted, like in poker.
Exactly. It's full tilt.
Yeah.
But it's worse than poker because they don't do the math on their stop losses.
Because of the fake $100,000.
They think, oh, I have a $100,000 account, so they size their trade for a $100,000 account. They put on these huge lot sizes, totally forgetting they only have $4,000 of actual breathing room left before they fail the entire challenge.
Yep.
And then the market twitches again, just a minor normal fluctuation, and boom, they hit the 5K limit. Poor position sizing combined with emotional tilt is what triggers this massive 40% failure block.
Right, because it's a $5,000 account.
Oh my God.
No, seriously, if they treated it like a 5K account, they would never put a trade on that could lose $4,000 in one twitch. You are literally proving my exact point.
I am not proving your point.
You are. The marketing messes with their psychology. They think they're managing $100,000. They feel like big shots, so they trade way too big.
Okay, we're just talking in circles now. We're going in circles. The point is, you have to manage risk based on the loss limit, not the total balance.
Oh.
If you do not grasp that concept, you are going to be part of the 40% that blows up on day one. You just are.
Fine. I still think it's deceptive.
But
Yeah.
honestly, as brutal as the daily loss limit is, it's almost preferable to the other way people fail.
Preferable. How is losing preferable?
Because at least the daily limit is fast. You blow up, you're done. You can close the laptop, go outside, touch grass.
Okay.
The other way is torture.
Torture. Great. Okay. What is the torture way? What's the next big killer on your spreadsheet?
Well, it's not always a massive emotional blow up.
Mm.
A lot of the time, people think they are being incredibly careful.
Okay.
They are managing their risk perfectly. They are nowhere near that $5,000 daily limit we just argued about.
So they're doing what they're supposed to do.
Right. But they still fail
Yeah.
because of the maximum drawdown breaches.
The maximum drawdown.
Yes. This is 30% of all failures in the data set. I call it the silent killer because you can fail the entire evaluation without ever coming close to hitting your daily loss limit.
Wait.
I'll show you the math.
No, wait. If I don't hit the daily limit, I'm surviving, right? If the rule is don't lose 5K in a day, and I don't lose 5K in a day, I'm still in the game. That's logic.
No, because there's a total maximum drawdown limit, too. It's usually around 10% of the starting balance over the entire life of the account. Let's do the death by 1,000 cuts math here, because this is how it happens. Say a trader. Let's call him the careful trader.
Sure, careful trader.
He is trying to be super safe. He takes a trade on a Monday, and he only risks 0.8% of his account, less than 1%. He is being incredibly responsible.
Okay, 0.8%. That's what, $800 on the $100,000.
Right, exactly $800.
Right.
So if the trade loses, it goes against him.
Okay, fine. 800 down.
Next day, Tuesday, he comes back. He finds another setup. He risks another 0.8%. It loses.
Bummer.
Wednesday, he wins a little bit, but then he loses 2 more small trades.
Okay, I see where this is going.
Over the course of a couple of weeks, he takes, say, 30 trades. He wins some, but he loses more. Let's say he nets out to 15 losses of 0.8%.
15. Okay, wait, let me do the math.
15 times 0.8% is a 12% total loss.
Okay, 12%.
He feels safe because on any given day, he never lost more than like 1 or 2%. He was nowhere near that 5% daily limit. He thought he was managing his risk perfectly.
But he hit 12.
Exactly. 15 net losses of 0.8% is 12%. He just silently breached the 10% total maximum drawdown limit. Account terminated.
Wait, stop.
With-
Who loses 15 times?
People lose.
No, seriously. Like, you could literally flip a coin, heads I buy, tails I sell, and do better than 15 net losses. How is someone losing 15 trades over a couple of weeks if they're actually trying?
Well, it's not always sequentially, right? It's net losses over time, like I said.
Yeah.
You win 5, you lose 10, you win 2, you lose 7.
Yeah.
It adds up. But also, this ties into another major finding in the data.
It is.
Excessive risk-taking to recover. Because when you start losing even small amounts, you panic.
Panic.
Yes, you lose 3 times, right? You're down, what, 2.5% total. You're down $2,500. You look at your dashboard, you see that red number staring back at you, and you just panic.
But if they're risking 0.8%, they aren't taking excessive risk. Your own example has them being cautious.
It's excessive in volume.
Oh, they just trade too much.
Yes, they start overtrading.
Yeah.
The market isn't giving them anything good. It's choppy. It's sideways. It's just garbage price action. But they force trades because they are slowly bleeding out, and they feel this ticking clock.
They want to get back to zero.
Exactly. They think, I just need a little winner to get back to break even.
Yeah.
So they take garbage setups, suboptimal trades, and the drawdown limit just sneaks up on them. They log in one morning, they check the dashboard, and they're locked out. And they're sitting there going, but I never took a big loss.
See, this is why I hate the whole structure of these things.
Hate is a strong word.
No, I do. It feels like, okay, it feels like you're walking through a minefield, right?
Sure.
The daily limit, the 5% thing, that's a giant landmine. You step on one, boom, you're dead.
Right.
But the firm also went in and put a bunch of invisible tripwires between the mines. So even if you tiptoe around the big explosions, you just trip on a wire and snap your neck anyway.
Well, if you think the max drawdown is an invisible tripwire,
Hmm?
you are going to lose your absolute mind when we talk about how they calculate that drawdown.
Oh, no.
Oh, yes. Because this is where people genuinely riot. This is the equity versus balance war.
The what war?
The equity versus balance drawdown calculation.
Mm.
You have to know the difference between a balance-based drawdown and an equity-based drawdown. This is a critical rule distinction that trips up so many people. If you are listening to this right now and you don't know which one your prop firm uses, you need to pause this and go check their FAQ immediately.
Okay, enlighten me. What is the difference?
Balance-based drawdown only counts closed trades. Your balance is just your realized money. Money that is locked in, safe, banked.
Got it. Real money.
Equity-based drawdown includes open floating P&L.
Open floating P&L. Translate that for someone who doesn't stare at Bloomberg terminals all day.
Okay, let's use a real example. Let's say you buy an asset. So you buy a gold contract.
I buy gold.
You enter the trade and gold surges. Massive spike. You're up $4,000.
Nice. I'm rich.
But you haven't sold it yet.
Yeah.
You haven't clicked the close trade button. You haven't taken the profit. That's floating P&L. It's unrealized.
Right. Paper profits.
Yeah.
It's not real until you sell. Everyone knows that.
Exactly. So under equity-based drawdown rules, which, by the way, a lot of the industry-leading firms use that floating profit, those paper profits, become your new high watermark for your drawdown.
Wait. Let me think about this. I need to walk through this slowly.
Take your time.
So let's go back to the 100K account.
Okay.
I buy gold. It goes up by $4,000. So my account, on paper, is sitting at $104,000 in equity.
Right.
But I haven't closed the trade. I'm letting it ride because I think it's going higher.
Sure.
Then the market turns around, the Fed chair gives a speech, inflation data comes out, whatever, and gold drops. My equity drops back down to, let's say, $99,000.
Right.
So I close the trade at $99,000. From my starting balance of $100,000, I am only down $1,000. I lost 1% of my account.
Ah. But from your highest equity point of $104,000,
Yeah.
you were down $5,000.
Wait, no, wait. So if my account goes up $4,000, I don't close the trade because I'm aiming for a bigger target. It dips back to $1,000 below my start. I could fail the entire 100K challenge even though I never actually lost my own money.
You failed the daily loss limit, yes.
Yeah.
Because your open equity dropped by $5,000 from its intraday peak, you are done. Account blown.
That's rigged. It's not. That is actually objectively rigged. It actively punishes swing traders who hold trades overnight.
No, it just...
If I'm playing a long-term trend, the market breathes. It goes up, it goes down, it fluctuates. You're telling me I can fail a test because the trade was too profitable for an hour while I was at lunch, and then it came back to my entry price.
Look, I get why you're mad. I really do. But you have to look at it from the firm's perspective.
The firm's perspective is stealing my fee.
No. Unrealized gains are still capital. If the market gives you $4,000 in open profit, and you just sit there and let it completely evaporate and turn into a loss, you have poor risk management.
It's not poor risk management.
It is. The firm has to protect its capital from wild swings.
No, it's a trap door. They are literally weaponizing your own winning trades against you.
They aren't weaponizing.
Think about this. Think about the math you just said. If the trade never went up to 104,000, if it just hovered around break even all day and then dropped to 99,000, I'd still be in the challenge, right?
Yes, because you'd only be down $1,000 from the peak.
So I am being punished for being right initially.
No.
I am being penalized for the asset going up. How is that teaching anyone to be a good trader? You're supposed to let your winners run. Every trading book in the world says, cut your losers fast, let your winners run. But this rule says, if your winner runs, we will use it to hang you.
It's not a trapdoor. It's margin requirements. Listen to me. You have to understand the mechanics of how this works on the back end.
I don't care about the back end.
But you have to. Because if a real broker is holding your positions, they calculate margin based on equity, not balance. If your equity swings wildly by $5,000 in a few hours, the risk to the firm is massive. If you are up 4 grand, that is now the firm's money. If you lose it, you lost their money.
Honestly, it just sounds like they want you to scalp.
Wow.
They want you to take tiny little hyper-anxious profits instantly and never hold anything, because if you hold a winner, you risk failing the test if it dips even a little bit to retest a level. That is a terrible way to teach people to interact with the financial markets. It creates paranoid traders.
Well, you have to adapt to the rules. I'm not saying it's a perfect system for every style of trading. I'm really not. But it is the environment you are paying to participate in.
I don't want to adapt to a rule that tells me making $4,000 is a liability.
Okay, we're clearly not going to agree on the philosophy of this.
No, we are not.
But this is precisely why people listening need to know if they're taking a balance-based or an equity-based challenge. It's usually buried in the FAQ or the terms of service.
Of course it's buried.
Because if you are a swing trader, if your strategy relies on holding positions for days or weeks, catching big macroeconomic moves, you will absolutely get murdered by an equity-based trailing drawdown. It's just math. You will hit the limit during a normal market pullback. You have to know the rules. You cannot just blindly buy a challenge because the website looks slick.
Yeah, well, the main rule seems to be we keep your fee no matter what.
Fine, be cynical.
Oh, I am being realistic.
Let's just look at the third killer. Because if you think the equity drawdown is bad, this one is going to make you even more mad. Let's talk about overtrading and consistency rules.
Oh, good. Fantastic. More invisible rules to fail by. Let's hear it. I can't wait.
So a lot of these firms, to make sure you aren't just getting lucky, they require that no single day represents more than 40 or 50% of your total profits.
Why? What does that even mean?
Okay, let's walk through the math again. Let's say you survive the drawdowns. You're navigating the minefield. You didn't hit the daily loss. You didn't hit the trailing equity trap.
A miracle.
Right. The profit target to actually pass the challenge and get funded is $10,000. You need to make 10 grand.
Right. Simple enough. 10 grand.
You sit down on Monday, you catch an incredible trend, you execute flawlessly, you make $6,000 on Monday.
Great.
Best day of your life. Tuesday, you come back, market is still moving your way, you make another $6,000.
Okay, I'm crushing it.
You are now at $12,000 total profit. You hit the $10,000 target. You are popping champagne. But guess what? You fail the challenge.
Wait, what? No, I made 12 grand. The target was 10.
You fail. Your account is not passed.
Why?
Because one day, either Monday or Tuesday, they were both 6 grand, represented more than 50% of your $10,000 goal. 6 grand is 60% of 10 grand. You violated the consistency rule.
If I hit the profit target, pay me.
That's not how it...
Why do you care if I did it in 2 days or 20 days? It's literally moving the goalposts so they don't have to pay out. That is the exact definition of moving the goalposts. Oh, you won, but you won too fast, so actually you lose.
It's not moving the goalposts, it's anti-gambling.
It's arbitrary nonsense. If I'm supposed to make 10 grand and I make 12, I pass the test. If I take a history test and finish it in 20 minutes instead of an hour, the teacher doesn't fail me for being too fast.
Okay, you have to understand the business model of these prop firms to understand why this rule exists.
The business model is stealing. We covered this.
No. Consistency rules prevent someone from YOLOing a single news event, getting incredibly lucky, and passing. You see this all the time in the retail space.
See what?
Non-farm payrolls come out. Or CPI data drops. The market spikes 100 pips in 3 seconds.
Yeah.
Some guy who has absolutely no idea what he's doing goes all in, highly leveraged, and just happens to guess the right direction. He hits the Tenko target in 30 seconds. That's not trading. That's pulling a slot machine lever. The firm wants to know you have a consistent, repeatable edge, not just dumb luck. It protects you from yourself.
Protects me from myself.
Yes.
Right. Yes, thank you, massive financial corporation, for protecting me from the terrible burden of passing your test too quickly. I feel so protected right now.
You're completely ignoring the reality of what happens next. It protects the firm's capital when they actually fund you. Think about it. If they give you real money or put you in a live environment and your only strategy is gambling maximum leverage on CPI data releases, you are going to blow up their actual money eventually.
Maybe.
Not maybe. The probability catches up with you. That's why they need to see a smooth equity curve. But there's another layer to this. A lot of these firms operate on what's called a B-book model.
A B-book? What is that?
Okay, so an A-book breaker takes your trade and routes it directly to the real market, to a liquidity provider. A B-book broker, which a lot of prop firm evaluation phases use, keeps your trade in-house. It's simulated. They're essentially taking the other side of your bet. They're the casino.
Wait. So my trades aren't even hitting the real market.
During the evaluation phase, often, no. It's a simulated environment hooked up to live market data.
Oh my God.
So if you pass by getting insanely lucky on a news spike, and then they transition you to a funded account where they actually have to pay you out of their own pocket if you win, they are terrified of you.
Because I'm unpredictable.
Exactly. They do not want a gambler on their books because if you gamble and win, they bleed cash. So they put in consistency rules to filter out the gamblers.
Okay, I guess I understand the corporate logic of protecting their own wallets, sure. But it still feels incredibly deceptive to the user. Like, you sign up thinking you just need to hit a number, but actually you need to hit a number in exactly the specific rhythm and tempo that they dictate.
Exactly.
Yeah.
Which brings us to the fourth failure reason, which is heavily tied to this fear of news spikes. Restricted period trading.
Let me guess. You can't trade when the market is actually moving and offering opportunities.
You cannot trade during major high-impact news events. You can't hold positions over the weekend because of gap risk.
Gap risk.
Yeah. When the market closes on Friday, something happens in the world on Saturday. Some geopolitical event and the price opens way higher or lower on Sunday night.
Right.
Or rollover periods when banks change the daily interest rates. Some of these firms, they have this dreaded 5-minute window rule.
The 5-minute window. Do I even want to know?
It means you cannot open a new trade or close an existing trade or even have a pending order triggered within 2.5 minutes before or 2.5 minutes after a major economic announcement.
Are you joking?
If you do, even accidentally, you violate the rule. Account terminated.
Honestly, it's like reading the Apple terms and conditions. Nobody does it until their account is banned. How is anyone, especially someone just starting out, supposed to keep track of a 5-minute window on a random Tuesday?
You check an economic calendar. It's free online. It's not a secret when the chairman of the Federal Reserve speaks. It's scheduled months in advance. You know exactly when CPI is dropping.
Yeah.
But people don't look.
Because they just want to trade.
Right. They just wake up, they look at a chart, they see a pattern, they click buy. And then 3 minutes later, the market goes insane. They get slipped, and they get an automated email saying they violated the restricted period rule.
Wait, you said slipped. What's slip?
Slippage.
What is that?
Okay, so during a major news event, the order book, which is the list of all the buyers and sellers waiting at different prices, it completely empties out because the big institutions pull their orders. They don't want to get caught in the volatility. So liquidity dries up. If you have a stop loss set at, say, $100,
Right.
a stop loss is just an automated market order that says, get me out at any price once we hit $100.
Right. To protect you.
But if there are no buyers at $100, the computer has to look lower and lower to find someone willing to take your trade. It might not find a buyer until $95.
Oh.
So you get slipped. You plan to lose $50, but you end up losing $500. And that massive slippage pushes you over the daily loss limit.
Okay, so let's review this absolute nightmare.
Let's do it.
You can fail because you lost too much in a single day.
Yes.
You can fail because you lost a tiny, responsible amount multiple times over a month.
Correct.
You can fail because your trade was too profitable and then dipped, triggering a trailing equity drawdown.
Sadly, yes.
You can fail because you made your profit too fast and violated consistency. And you can fail because you traded at 2:03 p.m. instead of 2:06 p.m. and hit a 5-minute restricted window.
I mean, when you list it out back-to-back like that, it sounds bad.
It sounds like a racket. It sounds like an obstacle course designed by sadists. How does anyone pass this? You said 5% of people actually get funded. Are they just wizards? Do they have supercomputers?
No, they aren't wizards. It's a highly regulated environment because the risk of giving out capital, even simulated capital, that converts to real payouts is immense. But there is a survival guide here.
A survival guide.
Yes. The data actually points to exactly how you survive this minefield. And the first thing you have to understand if you're listening and you actually want to try this is the statistical difference between one-phase and two-phase challenges.
Okay, I assume one phase means you just pass one test, and two-phase means you have to pass 2 tests in a row to get the money.
Basically, yeah. Two-phase challenges usually have a phase 1 profit target, like 8%,
Yep.
and then a phase 2 target, usually lower, like 5%. You have to pass both consecutively. One-phase challenges, you just hit, say, 10% once, and you're funded. Now listen to this stat, because it breaks people's intuition. Two-phase challenges have an 18 to 22% pass rate in our data set.
Okay.
One-phase challenges only have a 10 to 15% pass rate.
Wait, wouldn't a one phase be easier?
You'd think so.
No, seriously. You only have to pass once. Statistically, doing something hard twice should lower the pass rate, not raise it. If I have to flip a coin and get heads, I have a 50% chance. If I have to get heads twice, it's 25%.
Mathematically, it seems like a one-phase is the shortcut. But one-phase challenges usually have much, much tighter drawdown rules.
Oh, of course they do.
Because the firm is taking on more risk by only evaluating you once before handing over access to payouts, they compress the daily loss limits and the max drawdown limits. So maybe instead of a generous 10% max drawdown over 2 phases, you only get a 6% trailing drawdown on a 1 phase. They squeeze the life bar.
So they give you less room to breathe.
It makes it statistically much harder to survive the normal, everyday volatility of the market without tripping a wire.
So they tempt you with a shortcut. Hey, pass in one step, but the path is covered in landmines and invisible tripwires.
Exactly. It's a psychological trap. People want the money faster, so they take the 1 phase, and they get chopped up by the tight equity drawdown we talked about earlier. So if you're listening, the data strongly suggests you are actually better off taking the longer, boring 2-phase route because the breathing room on the drawdown is wider. It lets the market breathe.
Makes sense.
But even then, even on a 2-phase, you need a mathematical strategy to survive the rules. And the most important one is what I call the 50% rule strategy.
Which is, do I just trade 50% of the time?
No, it's about your mental limits. You never, ever exceed 50% of your maximum allowable drawdown. Mentally, you cut the firm's rules in half.
Cut them in half.
If your max drawdown is 10%, you write it on a Post-it note on your monitor that your max drawdown is actually 5%. If your daily limit is 5%, you act like it's 2.5%. You set your personal hard stop losses there.
Okay, but why? If you have the 10%, why not use it? That's your buffer. Why artificially shrink your own buffer?
Because of what I just explained. Slippage. Or a sudden spread widening. Look, if you push your account right to 9.9% drawdown and you say, okay, I'm cutting it close, I'll close the trade now, you click close. But the market spikes in that exact millisecond. Or the spread, the difference between the buy price and the sell price suddenly widens because of low liquidity. You might get filled at 10.1%.
And you fail.
And you fail. It's automated. A computer just reads the number and locks you out. If you build in a 50% buffer, you never have to worry about the firm's automated system kicking you out because of a microsecond market anomaly.
I guess that makes sense. It's like driving the speed limit so you don't accidentally go 1 mile per hour over when going down a hill and get a ticket from an automated traffic camera. You just stay well below it.
Right. Exactly. It's defensive driving for trading. And the second part of the survival guide, and this is where people really, really struggle with their ego, is the 30% daily stop strategy.
Let me guess. You stop trading after you make 30% of your target.
Yes. If your overall goal is a $10,000 profit for the challenge, and you have a great morning and you make $3,000 in 1 day, you close the laptop. You physically get up from the desk and you stop trading for the day.
But if the market is moving, why stop? If you have a setup and the trend is strong, why walk away from money? That goes against everything traders are taught about maximizing opportunities. If it's raining gold, you grab a bucket, you don't go inside.
Because of the consistency rule we just argued about. If you keep going, if you grab a bigger bucket and you make $6,000, you violate the 50% consistency rule and you fail the challenge, even if you hit the target later. You have to pace yourself artificially.
So annoying.
But also, beyond the rules, greed leads to the 40% failure rate we talked about in section 1. I see it in the data constantly. It's a psychological pattern.
What pattern?
The God complex.
No, boy.
Seriously. You make $3,000 in 2 hours. You feel invincible. You think you can see the matrix. So you take another trade in the afternoon, but it's a suboptimal setup. The market has chopped out, but you force it. You lose $2,000.
And you get mad.
Now you're mad. You were up 3, now you're only up 1. You revenge trade to get the $3,000 back before the bell rings. You increase your lot size, and boom, you hit the daily loss limit. You go from up 3,000 to blown account in 4 hours. The only way to prevent that is a hard mechanical rule to walk away.
It hurts my brain. You're basically saying you have to trade not to lose rather than trading to win. It's entirely defensive.
You're matching your style to the rules. That's the secret. That is the only way the 5% actually get funded. Look, if you are a scalper, someone who's in and out of the market in seconds or minutes, taking tiny bites, you must choose a firm with tight daily limits, but maybe they don't have consistency rules because you take 50 trades a day anyway. If you are a swing trader, holding for days, you need generous max drawdowns, and you absolutely unequivocally cannot use a firm with an equity-based trailing drawdown. You will die. You have to read the fine print and match your personality to the terms of service.
I just can't get over the fact that you have to practice taking a test to take a test. It feels so disjointed from actual economics.
You do. You have to practice on a demo account under the exact challenge rules before paying a dime of your real money. You track your fake trades and see, okay, would I have hit the consistency rule today with these fake profits? Would I have tripped the daily loss limit on that one random spike at 10 a.m.? If you don't run that simulation on yourself first, you're just throwing evaluation fees into a fire. You are funding the prop firm's marketing budget.
Look, the data shows what it shows. I guess I see the math, but I don't have to like it. It feels gross.
The core thesis here, look, the data proves that failures are mostly rule violations, not a lack of trading ability. It's a lack of environmental awareness. Systematic rule awareness beats pure trading skill every single time in these challenges. You can be mediocre at calling market direction, but if you manage your drawdown perfectly, you will outlast the genius who tilts and blows his daily limit.
Honestly, that just means the best traders aren't winning. The best rule followers are. You could be a savant at reading price action. You could have a brilliant macroeconomic thesis on the yen. But if you don't read page 4 of the PDF on restricted trading hours, you're a loser, according to the firm. It rewards compliance over brilliance.
So you have to ask yourself,
Yeah.
if you were listening to this, sitting in front of your charts, getting ready to buy one of these challenges, are you actually learning to trade the global financial markets, or are you just learning how to beat a very specific, highly regulated video game designed by a prop firm? Think about that before you pay the entry fee.
I need an aspirin.